As we move into second semester, we will begin with Chapter 9, left off with Chapter 8 in first semester. In Chapter 9, we are going to be starting a new business. In first semester, we used Delgado Web Services, and Delgado Web Services was a sole proprietorship, meaning there was just one owner, Michael Delgado. Now we are moving on to a corporation. So you'll notice we'll have some different accounts. We'll have multiple owners, which will affect some of our account names. In addition, instead of being a service business, like Delgado Web Service provided the web services, we are now going to be a merchandising business, meaning we are selling goods. So that will add some additional accounts. So merchandise, that is what you physically buy. Buying something at a store, something that you could hold in your hands and purchase, unlike a service like we had in first semester. So therefore, a merchandising business, that would be a business that sells merchandise. So oftentimes the merchandise has to be purchased from another company, such as Scheels purchasing items from Nike that then they could resell at Scheels. So it's important to know the difference between a retail business, our third bullet point there, which buys and sells goods to consumers, and then a wholesale merchandising business, which is our fourth bullet point there, that is buying and selling merchandise to retailers. So retail merchandising is like a retail store at the mall. Us as consumers go in there, purchase the goods, purchase the merchandise, and leave the mall. Wholesale merchandising business, they buy and resell merchandise primarily to merchandising companies. So wholesale businesses would sell to resale businesses. Like I said earlier, we're going to be talking about corporations. Corporations are organizations owned by multiple persons, unlike a sole proprietorship. So a corporation has many legal rights because all of us could be owners of a corporation by purchasing stocks. So corporations are owned by stockholders. In order to have stocks available to purchase, you need to be legally organized as a corporation, which we'll talk about here in a little bit. And that is not something that just anyone can do without a lot of paperwork. Something to note, in first semester, we had owners, equity, capital, and drawing, and it was Michael Delgado drawing, Michael Delgado capital. Now, it is going to be organized differently, and any financial resource available to the business, we are going to refer to as capital, including our assets. So a little bit different, and we'll talk about that later. Like I said, if we purchase a share of stock of a company, so if we buy a share of Apple stock right this second, one share, we become a stockholder for Apple. And as a stockholder, that means that we are an owner of the business. Obviously, just a small portion of the Apple business, but as a stockholder, you become an owner. The third bullet point, the total shares of ownership in a corporation are called capital stock. So however many shares are out there purchased, that times the value of each stock is referred to as our capital stock. So the value of the company would be the capital stock. Like I said, in order to be a corporation, that is not something that is simple to do. If you have a lawn mowing business, it's not simple to become a corporation and have your friends purchase stocks in your company. You need to go through a lot of legal paperwork. Articles of incorporation, this is the legal document that identifies the characteristics of the corporation, and it has to be submitted to the state that you operate. So for instance, Amazon operates out of Seattle, Washington. So the state of Washington had to approve their articles of incorporation. Once the state approves the formation of the corporation, our second bullet point there, a company is issued what's called a charter. This is the legal right to operate as a corporation. Think of a charter as like all of us with a driver's license. That gives us the legal right to drive a vehicle. A charter gives the company the legal right to operate as a corporation. Some more vocab here. So a vendor. So Scheels, back to that example, Scheels would purchase merchandise from multiple wholesale companies. Think of all the brands that they carry at Scheels, Nike, Under Armour, Patagonia, North Face, etc., on and on and on. So they would have several vendors that they purchase this merchandise from. So anything that is purchased merchandise or supplies from another company is called a vendor. So we have lots of vendors. Scheels would have lots of vendors. So we are going to talk about organizing those vendors in something called a subsidiary ledger. So now we are going to have a overall controlling account, and then folders. Think of it like organizing folders within that controlling account. And those folders are the subsidiary ledger or the sub-ledger. So talking about our accounts payable ledger, accounts payable would be all the money that we owe to every single vendor. That is called the controlling account. Within the accounts payable ledger, we have a subsidiary ledger, and that would list out each vendor that we owe money to. This slide gives a good graphic of how this looks. So on the left-hand side, you could see all the vendors that this company owes money to. Bearden Chemicals, Estes Supply, Gale Electric, etc., etc. Those are all companies that we owe money to. And if you add up those individual amounts that we owe, that is our total accounts payable amount. So each of these individual amounts added together equals the total accounts payable that we owe. So if we wanted to know specifically how much we owed one company, we would go into our subsidiary ledger and find that vendor. But if we just wanted to know in general how much money do we owe to companies, you can go to our controlling account here, which is accounts payable. Accounts payable, nothing changes, increases with a credit, decreases with a debit. So nothing changes there, just our organization of the ledgers. So now we have a new ledger form. Here at the bottom is the ledger form that we had first semester. Notice we have the date, we would normally put the page number, debit or credit, and then whether our balance is a debit or a credit. So that's all the same. On our vendor, our new ledger here, you'll notice that something is different. So we get our account name in there, we get our account number. Notice it's a vendor number rather than account number. Date, we'll have our balance, stating that this is the first time that this is recorded, and then a check mark because it's not coming from a certain page number. And then notice that the only option for account balance is a credit, because these are amounts that we owe. Accounts payable increase with a credit, so we would never have a debit balance for accounts payable, so we don't even have a debit column. So that is why it is slightly different from our accounts payable ledger. So that is our subsidiary ledger form for our vendors. Slightly different from what we're used to, but it actually simplifies. So on your note guide, you now have 5 questions that you can answer. Starting with question number 1, feel free to pause this video, get your 5 questions answered, and then start back up the video to see the answers.